All right, let's talk more about overall markets. Joining us now, Kate Moore, Chief Investment Officer at Citigroup Wealth. And Kate, you are looking at certain indicators that there are growth concerns, obviously. And today we got oil under 60. The Fed's not going to come to the rescue anytime soon, but you see fundamentals starting to deteriorate. You think we'll see that in the GDP print? And I guess a 416 on a 10-year also indicates maybe some growth concerns. Why did the market? Is it early? Is the market anticipating things aren't as bad as we think? Or are we just ready to head back down?
Look, so I'm not calling for a significant cratering of the U.S. economy over the course of the second quarter. But we have been on a path of deceleration for a number of quarters right now, especially when it comes to some segments of the consumer. That's a big area that I've been watching. The point I was trying to make, though, around the Fed not coming to the rescue, I think is really important. We've gotten into this pattern of expecting policymakers to step in to offer some kind of significant support or a floor into the market every time there's any kind of volatility or any kinds of growth concerns. And I think at this point, the growth data looks okay. It looks pretty good. Activity has been holding up. We can talk about whether some of that is pull forward of demand. The labor market, I expect, will look pretty solid even after Friday's report. And so it puts the Fed in a difficult place. If we're worried about growth later on down the line, that's one thing. But I don't think they're going to be in a rush, frankly, to make a significant change in policy moves.
We keep talking about how all this data is backward looking, though.
Totally.
Not just from the inflation perspective. Inflation looks a little better, but the growth is backward looking, too.
Yeah.
Are there more immediate, unusual data points than we normally watch that would indicate that, hey, there is a reason to kind of step in here and make sure that the economy doesn't drop off, the jobs market doesn't drop off sharply?
Well, the data, or at least that the indicators we're looking at that are throwing up all the flags, of course, are the soft data, all the survey data, everything coming out of, regional Fed surveys and corporate CFO surveys and the words that we're picking up on the earnings season and during reporting calls. But that is not fact at the moment. And if you're a policymaker, you have to base your decisions on fact or at least a reasonably secure forecast. And I think that puts the Fed and other policymakers in a difficult place because things have not deteriorated significantly or enough to really change the course of policy action yet.
And I'm looking for the canary in the coal mine. And that's why I sort of said you got bonds and oil looking like there's something, we're on maybe a precipice, a growth precipice where we had that. But why the markets recover so much? They're always early, I guess. They anticipate relief or whatever. And you actually say that at this point they're susceptible to a relief rally based on could be a lot of different things.
Yeah. So I think a lot of it had to do with what happened to positioning, not just over the course of the first part of this year, but over the last 4 to 5 weeks where people really shed a lot of length, especially in U.S. equities. And we're looking for any bits of good news, whether it was around tariff, around policy, on the monetary policy side. So here's what I will say. The canary in the coal mine for me would be if many, many companies cut their guidance, which we haven't seen as of yet, right?
We've seen some.
We've seen some, and some bellwethers.
At least taking off, saying we don't know.
Yeah. But they're not saying everything looks so catastrophic in a steady state economy that we have to cut all of our guidance. That's scary.
And that we have to lay people off and that we have to stop our CapEx spending. That's
Exactly. People are trying to, the CEOs and CFOs that are communicating to the investor community are trying to calm the market somewhat. So I find some comfort in that. What I will say is the companies that have done this dual track of guidance are my favorite, frankly, who say in a steady state environment, this is what might happen. In the worst case tariff environment where we might actually see this secondary impact on overall demand, here's how we will shore up our businesses. I love that kind of forecasting.